Morning, everybody. You're all very welcome to this morning's briefing on the results for the Q3 2020 national accounts and international accounts. I'll just go through the housekeeping as people are joining the briefing this morning. So we've set all the microphones to mute, and we will keep them on mute as we go through the presentations on the results. But we'll take questions at the end of the presentations. And can I ask people to use the Q&A function for questions, or alternatively put your name in the chat function and we'll take you off mute for your question. Given the need for social distancing, we're again using the virtual format this morning, and we have had to suspend the usual 10:30 pre-release briefing, but our plan is to reintroduce some format of that in 2021. We want to keep the best of both worlds with the person-to-person, but also the virtual briefing as well. Today's results for Q3 cover the summer months, July, August, September, and the easing of the COVID-19 related restrictions that time. So the significant impact of this easing on the national accounts and international accounts in the quarter will be explained by the colleagues here this morning. Slides from today's briefing are available along with the statistical releases on the CSO website, cso.ie, and we're hoping to have a recording of today's presentations loaded to CSO's YouTube channel. But as always, you can contact us at any stage with queries on the statistics, and the contact details are available on the statistical releases and on the press release from today's results. I'll pass now to Chris Sibley, who will take us through the Q3 results for the national accounts. And Chris will then pass to John Sheridan, who will take us through maybe a bit more detail in the international accounts, some of the globalization activities we see in the national accounts. So I'll pass over to Chris now. Thanks very much.
Thanks, Jennifer. So I have the Q3 2020 national accounts for you this morning. It's a complicated set of results in a difficult period to measure data, as you'd imagine, with the 3 quarters during 2020 having its own measurement challenges. As Jennifer mentioned, the easing of restrictions in Q3 is a key feature of this morning's presentation. We presented the Q1 data with the schools closing mid-March and having a partial effect on Q1. And then with the full lockdown at the end of March, we saw the Q2 effect on the fall in data there, and then an easing of restrictions throughout May and June. So the Q3 results are very much a rebound on those Q2 results that we presented to you 3 months ago. Many sectors have come back very strongly, but not all data. Many series have not reached the same value from a year previously. So our headline number this morning is a GDP growth rate of 11.1%. That's seasonally adjusted quarter on quarter. The current price data has almost reached 100 billion in the quarter for those who are interested in looking at the size of the economy. That 11.1% again has come from strong growth across a lot of sectors, a rebound in domestic data, and continued strong growth in the M&E data, particularly pharma and ICT. That strong growth in the M&E data has led to large profits flowing out in the quarter, and our GNP resulted minus 1.9%. And I'll perhaps leave the profits to John to talk a little bit more about later. We have some revisions to Q1 and Q2. Rerunning the data with the extra quarter, there's some changes to the seasonal adjustment. Some of the investment data has moved from reclassified from Q1 to Q2. And Q2, some of the agricultural subsidies have been reclassified to other sectors. And we have better than expected data received for VAT or taxes on products in Q2. So slightly less of a fall in Q2 than we previously published. If we look at the 11.1% then across countries, we've selected a group of European countries in the chart. It puts the 11.1% in context. The countries that fell the most came back the most in Q3, with France, Spain, Italy, and the UK on one side, with a large rebound after the fall, and the countries that fell less, Lithuania, Sweden, Romania, hence not coming back as much in Q3. If we look across the sectors and see where the 11.1% growth has come from, the wedge here gives you the size and the importance of the sector, and then the growth in it is written the percentage on it. So the domestic sectors, construction is back 53.4%, Distribution, transport, hotels and restaurants, again, another largely domestic sector, showing very strong growth there of 46.9%. The public admin, education and health, we saw higher data there in Q2, and that's remained high in Q3. And then the M&E dominated sector, industry, which is a large part of our value added, that's up 4.6%. Notably then the ICT sector, another M&E sector, is up considerably, up 24.9%. We'll talk a little bit more about that later. If we look at the data across time, we can see again that the public admin, education and health, that spending and that sector is value added, it's held up. The domestic sectors, largely domestic sectors that fell, construction and distribution, transport, hotels and restaurants, they've come back. Professional admin support services have come back. That's a mixed sector. We look at it and we often say that the aircraft leasing data there makes it difficult to interpret. But there's other domestic activity in there too, like legal services, architects, engineers, advertising services. That's another sector that's come back. Industry's grown, but again, it's a very big sector, and the noticeable large increase is in the ICT sector. If we look at some other CSO series, some of the CSO monthly series, to try and get a picture behind the quarter, many of you are looking at high frequency data and indicators to try and get a handle on where things lie. When we try to put this into quarters, we can see mixed results, and they're a little difficult to interpret, I guess. In March, we saw that increase in pharma production, particularly in monthly manufacturing, and we saw another large increase in July, which falls into our Q3. So we're comparing that Q3 with the fall and rise of the easing restrictions in Q2. Services has a similar picture with the red and blue, so it's April and March falls in the data. And then the return to growth in June, July, August, for example, in accommodation and food services. The purple June number and the blue July and the orange August number, all showing increases. Other services there on top also shows an increase in July, and that's made up of real estate, gambling, sporting activities, and other personal services. If we turn to the expenditure side of the accounts, again, to try and explain the 11.1% growth rate and where does it come from, the weights or the importance of the different categories of the expenditure side are on top, and their changes are in the boxes at the bottom. So we see the large effects exports and imports have on our economy and the GDP growth rate. But then we can see what the other contributions are as well. So PCE, or consumption, is up 21.3%. That's the rebound from the fall we saw in that last quarter. The government spending is largely holding up on the increase we saw in Q2. The investment data is up 4.4%. Now, there's a couple of things behind that. There's a fall in some intangibles and aircraft, but by and large, the underlying domestic data, the building, construction, and machinery and equipment is quite strong. So adding those together, along with the strong exports in the quarter, is what gives us our GDP growth rate of 11.1%. If we look at consumption then, to see, well, what is going on behind the 21%, 21.3% seasonally adjusted consumption number, we see goods are up 30.2%. And services are up 15.1%. The goods number is not quite as strong as what you might have seen in the retail sales index due to compositional differences for goods. And services hasn't had the same rebound from the easing of restrictions as you can imagine. So passenger fares, restaurants, and foreign travel are still down in terms of services. So that hasn't quite come back to the level that you might have expected. If we look at consumption across a range of our peers, European countries, it's the same picture again as we had with GDP. The countries that fell the most have come back the most and rebounded. So Ireland's up there with Spain, the UK, in terms of the swing around or the rebound in personal consumption expenditure. We can see a little bit of detail on that in terms of CSO's monthly retail sales index. With continued growth throughout July, August, and September in cars at the bottom, blue, orange, and grey for July, August, and September. the growth in clothing in July, and the growth in books in July and August, with department stores up in particular in August. So there's a different pattern across different months, depending on the easing of restrictions in different parts of the country as well. But again, it gives you a little bit more of a picture behind the Q3 data and where the strong growth or the rebound has come from. Another part of the CSO's retail sales is to show you the online sales from Irish-based retailers. So this was particularly useful, I think, in Q1 and Q2, where we saw the increase in online sales. Q3 is fairly stable in the data, but it gives us a little bit of a hint towards Q4 with some of the October increases in online sales from Irish retailers. So just to stand back a little bit and look at the CSO's retail sales index with the monthly changes in that, and we tried to then pin the quarters to this. So we can see the full lockdown in March at the end of Q1, the fall and the rise again with the easing restrictions towards the end of Q2, and then the growth in Q3. So the full 3 months are giving us this rebound of growth in Q3 over the turbulent data that we had in Q2. If we then stand back and try and look at domestic demand and imports, modified imports, we can see the large effect in the Irish economy of exports in green and imports in purple there. So whenever we have large IP imports, it makes it very difficult to interpret the data. We haven't had that issue the last 2 quarters at the same extent. So we can look at the increase in net exports in blue, mainly because what we see is the surge in pharma production of medical devices and in the ICT sector, in particular Q3. So that net exports growth is quite clear, but that allows us then to look at domestic demand and our new measure, modified domestic demand, which takes out IP and aircraft. And that gives us a modified domestic demand growth rate quarter on quarter of 18.7%. Again, reflecting the rebound from the fall we saw in modified domestic demand in Q2. We can take the same data and we can decompose the growth rate. So if I just quickly look at the bottom part of this chart and look at Q3, the total size of the stack there is the 11.1%. And we can see that the orange part, domestic demand, was responsible for 7% of that 11.1, and net exports were responsible for 4% of the growth in the quarter. And you can look back at Q2 and see that the fall in the quarter with domestic demand was offset by the increase in exports in Q2. Then to look at investment or capital formation, this is up 4.4%, but a lot of that is because of the fall in intangibles, quite a big amount of intangibles falling by 2 billion. But the growth in the domestic data, building and construction, is quite strong, and machinery and equipment is also very strong at 40 and 22.2% for each. When we take aircraft out of the machinery and equipment, that's up even further to 43.2%. So you can see that the multinational activity, the falls in some of the intangible spending, offsets some of the bounce back of the rebound in domestic building, construction, and machinery equipment. So even overall investment figure of capital formation of 4.4%. We can look at that over time and see the growth in the blue and red building, construction, and machinery equipment on Q2 and then Q3, Q2 into Q3. And we've also been able to lift some suppression on some of the quarters for Q2 and Q4 2019. That might be useful for some of our users, particularly to see the machinery and equipment numbers in those quarters. We stand back then after looking at the output and the expenditure side of the accounts. That gives us our GDP, which is up substantially in Q3. But at the same time, that large M&E activity in the quarter with the net factor flows increasing nearly 50%, up 10 billion on the previous quarter. That's given us a negative GNP growth rate quarter on quarter, seasonally adjusted. Again, I might leave the profits for John to talk a little bit about. So the summary in terms of the quarterly data. So quarter on quarter, seasonally adjusted GDP is up 11.1%. On the expenditure side, we see the rebound in the domestic side of the data with consumption up 21%. Government spending is held up to the high level as it was in Q2. Investment masked by some foreign activity underlying that is quite strong. Net exports are strong in the quarter, particularly the goods and the ICT services. And combining that, we have a final modified domestic demand increase of 18.7%, up from the fall we saw in Q2. On the output side of the accounts, we're seeing growth across almost all sectors, with the domestic activity up in construction and distribution, transport, hotels and restaurants. The public sector value added there is again remaining at the high level of Q2. Strong growth in the M&E activity in ICT and in the large industry sector of 4.6%. With net factor flows at 30 billion, again up about 10 billion on last quarter, giving us that negative GNP growth rate of minus 1.9%. Just a couple of things to mention before we finish. If you did, on the national accounts, if you did want to look at the year, we can look at the non-seasonally adjusted quarter-on-quarter growth rates, Q3 over Q3 19, with GDP up 8 and GNP down 3.7. You might particularly be interested in looking at the first 9 months of the year. So Q1, Q2 and Q3 are giving us a result of 3.8% and GNP up 0.2%. That's for the first 3 months of 2020. And that's for analysts perhaps to look at for the outturn then for the year. To explain that, because we're not quite back to the same period, or the same point we were in 2019, we can look at consumption and see that it's down 5.7% in the same period in 2019, while goods have grown since the same period last year, services haven't. So things like public transport, travel and restaurants aren't quite back in terms of services numbers to where they were this time last year. And then on the investment side, over the same period last year, building and construction is still down at 12.1%, dwellings are down 9.6% over the same period last year. Machinery and equipment is down also the same period last year, but a lot of that's affected by aircraft. So just some notes to look at if you wanted to look at year-on-year comparisons or perhaps at the outturn. But our focus is, of course, on the seasonally adjusted quarter-on-quarter data. So I'll hand over to John for the international accounts.
Hi, and now I'd like to take you through the international accounts for Q3 2020. And along the way, we'll expand on a couple of the points Chris raised, including the net factor flows. So if we look at our infographic, we can see it's a good summary of the quarter. We're seeing a good surplus of 36.8 billion, a services surplus of 5.6 billion, and net factor outflows of 29.7 billion. And they combine to give us our current account balance of 12.7 billion, or 12.8% of GDP. So our headline figure is the current account balance as a percentage of GDP. And we can see that from Q2 to Q3, which are both quarters with low levels of intellectual property imports, we're getting quite a stable time series, unlike 2019 when we had the volatility due to the intellectual property imports. So our current account balance as of Q3 2020 is 12.7 billion, or 12.8% of GDP. To look at that in a little more detail, we can see that the overall balance is 12.7 billion, which is up 1.1 billion on the same period last year. Our merchandise surplus is 36.8 billion, which is up 5.2 billion. Our services surplus is 5.6 billion, which is up 4.6 billion on the same period last year. And our net income outflow is 29.7 billion, which is up 8.7 billion on the same period last year. And this would be a large contributor to the net factor flows. If we look at the balance over time, we can see that the quarters where we have the lower than usual current account balance are accompanied by the large negative balances in services. And these are all driven by the large imports of intellectual property. Looking at the current quarter compared to the last quarter, we can see the increase in the merchandise balance. And we can also see the increase in the services balance, which is positive this quarter as opposed to last quarter. But we can also see the large increase in outflows that balance these. And so overall, the current account balance is up 1 billion. To look at this in a little more detail, we can see that the merchandise exports are 60.3 billion, which is up 2.9 billion on last year, while the imports are 23.4 billion, which is down 2.4 billion on last year. For services, we can see the exports at 53.9 billion, which is down 1.9 billion on last year. And we can see the imports at 48.3 billion, which are down 6.4 billion on last year. But we'll talk about that a little more later. Looking at the primary income, we can see that the inflows are 22.6 billion, which are down 6 billion on last year. And the outflows are 51.6 billion, which is up 2.8 billion on last year. This primary income will include portfolio and other investment income, which decreased in inflows and outflows compared to last year, but they decreased by a similar amount, so the impact on the net is quite low. However, if we look at the direct investment, we can see that the direct investment inflows are at 4.1 billion, which is down 1.8 billion on last year, and that's largely driven by redomicile PLC activity. Whereas the direct investment outflows are 30.6 billion, which are up 6.5 billion on last year. And it's this change, the combination of these two, that is largely driving the primary income balance and net factor flows. Looking a little more closely at goods exports and imports, we can see that for the Q3 exports, they're up quarter on quarter and year on year, while the goods imports are up quarter on quarter, but are down year on year. However, this is a similar story to Q2, where Q2 20 was down on Q2 19. Looking at the split between international trade, goods for processing and other, we can see that for the international trade exports, this is up quarter on quarter and year on year, while the goods for processing exports are down year on year, but we are seeing a large increase quarter on quarter, which is similar to the increase from Q2 to Q3 in 2019. On the import side, for international trade, it's up quarter on quarter and down year on year. Again, this is similar to Q2 being down on Q2 2019. For the goods for processing imports, we're down year on year, and we're also down quarter on quarter. But again, this change from Q2 to Q3 20 is similar to the change from Q2 to Q3 in 2019. Looking a little more closely at the service exports, we can see that we have an overall decrease of 1.9 billion compared to last year. But when we break that down, computer services have increased by 2.8 billion, while tourism services and transport services are down 1.5 billion and 2.1 billion respectively. And these are due to COVID effects. We are also seeing a reduction in business services of 1.8 billion, and this is partially due to decreases in operational leasing this quarter compared to the same quarter last year. Looking on the import side of services, we can see an overall decrease of 6.4 billion. Business services, we're looking at 2 quarters here, neither of which are largely impacted by intellectual property imports. So we're seeing a small increase in business services of 549 million. Royalties are down 5.2 billion on this time last year, but this is continuing the trend of lowering royalties from Q2. Tourism services are down 1.9 billion, which is continuing the COVID effect from Q2. To look a little more closely at these royalty imports, we can see from the high point of Q4 2019 that there has been a continued downward trend in royalties imports, which is following the large imports of intellectual property in 2019. We can see the split out here by sector. So on the pharmaceuticals, which is the green bar, we can see the decrease year on year in royalty imports, but we can also see a decrease in the grey bar, which includes information and communications. To look at the direct investment income a bit more closely, again, we have inflows of 4.1 billion, which are down 1.8 billion year on year, largely due to changes in redomicile PLCs. And we have outflows of 30.6 billion, which is up 6.5 billion year on year. And as I said, this combination is the main contributor to the net income outflows, an increase of 8.7 billion, and subsequently the change in net factor flows. To look at this a bit more closely, we can see that the income on debt is fairly flat, But the change from Q2 to Q3 is largely in the income on equity, which is made up of reinvested earnings and dividends and distributed branch profit outflows. To look at it again, split out by sector, we can see the increase from Q2 to Q3, but we can see that it's not concentrated in one sector, but is spread across the manufacturing and information and communication sectors. And both of these sectors are showing increases quarter on quarter and year on year. Now, to look at trade income and our current account with the UK, the trade balance with the UK has increased by 324 million, and the net income outflows have decreased by 1.8 billion compared with the third quarter of 2019. The result is a current account surplus of 1.3 billion in the third quarter of 2020, which is up 2.2 billion from the deficit of 899 million in the third quarter of 2019. When we look at the financial accounts, this quarter we aren't seeing the large net transactions that we saw in the previous quarters. We're seeing quite low net levels of transactions on the financial accounts overall. And if we look at our positions, we can see that our net international investment position stands at 602 billion as of the end of September 2020. And the change from the last quarter is largely driven by changes in non-financial companies. So to summarize our international accounts results, our current account balance this quarter is 12.7 billion or 12.8% of GDP. We're seeing continued low levels of intellectual property imports this quarter, as well as continued lower royalty imports. And the COVID effects continue into this quarter, showing up as lower tourism exports and imports, which largely net out for the current account, and lower transport services exports. So now I'd like to pass it back to Jennifer to summarise our release this morning.
Thanks very much to Chris and John. So just the key results from the quarter three figures here today. We have gross domestic product or GDP growth of 11.1%. Big contributors to that are the increase in personal consumption in the quarter and in exports in the quarter. Chris and John have both talked about the net factor flows and the big increases in profits of multinational entities in quarter three, driving that the contraction of 1.9% in GNP. The exports of goods and services up 5.7% in the quarter. Modified domestic demand, which is a broad measure of domestic demand covering personal spending, government spending, investment spending, and we see that at 18.7%. Just to underline as well that modified domestic demand, the impact of globalization activities such as intellectual property and aircraft leasing by aircraft leasing companies has been removed from that. So it's a very domestically focused indicator. And then our core domestic indicator of personal consumption expenditure, PCE, or spending on goods and services, what we all spend, has grown strongly in the quarter, 21.3%. Not quite, but almost reversing the contraction that we saw in Q2 for our personal consumption indicator.